With us is Schwab Asset Management CEO and CIO Omar Aguilar. And Omar, it's good to see you. What is your current thinking in terms of the likelihood of a Fed pause and how much that directly matters today for the markets?
Yes, thank you. Thanks for having me. The likely scenario so far seems to be going to what they call the hawkish pause, which is a little related to what we heard this morning with several Fed officials speaking in different places, which is they really clearly understand that the economy has been less sensitive to interest rate hikes. After 18 months of tightening, they continue to see that the economy is strong and, in fact, outperforming everybody's expectations, while they still see inflation pretty high and sticky. And with that, it is going to be more of a wait and see to know, yes, understanding that we're at the point where, we're probably closer to the end of the tightening cycle, but they still don't want to claim that this is the end because they want to leave their door open. Now, the implications to that is obviously the bond markets will continue to be volatile for the next, time, because we still need to get a little bit more certainty where the end of the line is.
Well, the economy, as you say, being less sensitive to changes in interest rates, at least so far, can be spun, I guess, as a positive, right? We had unemployment remain very, very low, in fact, lower than when the Fed started to tighten. Companies seem like they're talking about recession less in earnings calls than they were last quarter. Have we dodged a bullet or just pushed out the possibility of a broader economic downturn?
Well, it's clearly an interesting setup because, from the beginning of this tightening cycle, we've been talking about these rolling recessions. And certainly equity investors seem to be on the positive camp of thinking that we may have already dodged the bullet. Whereas if you look at the fixed income market, especially this year, it's actually quite the opposite. Every single signal in the fixed income and bond market will suggest that we're ready to just start a recession. So the two sets of markets seem to be signaling completely different stories, at least, so far in 2023. I think the key component, Mike, in this particular cycle seems to be down to the consumer. Consumers, continue to be in a spree of consumer spending that has, held our economy in pretty good place. When you actually look at leisure, when you think about autos, when you think about healthcare, supported by government spending, we continue to see that level of spending that keeping our GDP in a very good track. Now, the reality is that, as you clearly pointed out, corporations have also had a very strong balance sheets going into 2022 and 2023 that have held very well. And, 74% of the earnings just in the last cycle, of 74% of the companies beat their earnings just in the last cycle. So, the question is how much this will last. And at least in terms of savings for the consumers, we'll probably only last another 8 to 9 months when you actually look at aggregate data.
Omar, I guess the question is, how long will that last? It feels like we are sort of in this period where things are still okay. But when you think about the long and variable lag effects of Fed rate hikes, I mean, if you take a look at the JP Morgan Investor Day presentation today, they're setting aside reserves on the assumption that unemployment will peak at 5.8% in 2024. What does the economy look like under that sort of scenario?
Yeah, well, when you actually look at the projections overall, and I think the biggest part of what labor data and statistics seems to be completely distorted because, after, the 2020 and COVID, we saw a lot of these demographical changes that is affecting the way labor market, works. And a lot of these projections that ended up putting, unemployment, at a much higher level within the next 18 months seem to be just using the same level of demographic data that has been used in the past decades. When you actually look at, baby boomers retiring, and you think about the effect of immigration and the effect of the way our demographics work, the lack of workers seems to be keeping that unemployment at a very, equal level. And that's what we see so far. Even though we've seen some level of layoffs, we continue to see those trends to be very slowly moving. That is very hard to imagine that unless, there's, a significant economic collapse, that we can actually see unemployment, continue to rise at the level that a lot of these models, predict.